Palantir is one of the most powerful AI companies on Earth because they make 4 of the most powerful AI platforms on Earth. But with Palantir stock jumping up by over 40% after one of their best earnings calls ever, there's really only one question left to ask. Is this the top for Palantir stock, or are their best days still to come? Your time is valuable, so let's get right into it. First things first, if you consider yourself a value investor, then this video is not for you. Palantir's price-to-earnings ratio is well over 500, and if that's all it takes for you to ignore a generational winner, I want to respect your time. For everyone else, here's what I'll cover in this video: how huge Palantir could get over the course of the AI revolution, Palantir's massive quarterly earnings results, and the key numbers that I use to track their growth, and of course whether or not it's too late to buy Palantir stock now that it's over $110 per share, and where it goes on my list of stocks to get rich without getting lucky in 2025, which I would say has done pretty well so far this year. There's a ton to talk about, but I think the best place to start is with these quotes from Palantir's CEO Alex Karp during their latest earnings call. "We are at the way beginning of a revolution, and we plan to be a cornerstone, if not the cornerstone company, in driving this revolution in the US over the next 3 to 5 years. Our US business is at the forefront of the AI revolution, growing 52% year over year in Q4. Last quarter, Palantir's commercial revenue grew 64% year over year and 20% sequentially. And finally, in this AI revolution, the biggest risk is not moving fast enough." This is a really important observation by Alex Karp, and I think his 3 to 5 year time estimate is spot on, because the stock market has actually seen this pattern play out before. Here, let me show you what I mean. Technology tends to advance in cycles, and each cycle builds on top of the last. For example, there were around 1 million mainframe computers in the 1970s, but they were so big and expensive that only the biggest institutions, enterprises, and government agencies could afford them. But by the early 2000s, there were 1 billion desktops in homes and offices around the world. And by the end of the 2010s, everyone had a computer in their pocket that's many thousands of times more powerful and cheaper than the mainframe computers that we started with. This same trend is happening in artificial intelligence right now. The first large language models required billions of dollars to train, fine-tune, and run. But ever since OpenAI released ChatGPT a little over 2 years ago, the total cost and memory requirements for these models has been falling dramatically. So we're quickly moving from the mainframe computer era to the personal computer era, and then the mobile era for generative AI. This is the AI revolution that Alex Karp is talking about on Palantir's latest earnings call. But Palantir is a pure-play AI software company, so let me show you another chart from Morgan Stanley that looks at how different kinds of stocks performed over the mobile revolution, because I think the AI revolution is playing out the same way. Software and service stocks were the best performers over the mobile revolution, but they were also the last to rise, since software and services need an established infrastructure to run on. Think data centers for cloud applications and smartphones, laptops, and desktops at the edge. That's what all the tech giants are spending tens of billions of dollars in CapEx on right now. And before that infrastructure can be built, semiconductor companies need to build the chips that power it. That's why many of my top stocks to get rich without getting lucky are chip companies like nvidia and ARM, and cloud infrastructure companies like Google, Amazon, and Broadcom. So if we go back to this chart, we're probably somewhere near the middle of the AI revolution, where chip companies have flattened out a bit, infrastructure companies are just starting their run, and software companies still have a lot of room to grow. Software companies like Palantir. So Alex Karp is spot on when he says the AI revolution will continue for another 3 to 5 years, especially when it comes to software companies. And even though Palantir stock is over $110 per share, this Morgan Stanley case study suggests their growth is just getting started. In fact, according to Market US, the global artificial intelligence market is expected to more than 8x in size over the next 8 years, which is a compound annual growth rate of 30% through 2033. But many of the companies building next-generation AI applications are not publicly traded. Think about the 90s and early 2000s. Companies like Amazon and Google went public very early in their growth cycles, but today, they're waiting an average of 10 years or longer to go public. That means that investors like us can miss out on most of the returns from the next Amazon, the next Google, the next nvidia. That's where the Fundrise Innovation Fund, who's making this video possible, can help you. They give you access to invest in some of the best tech companies before they go public. Venture capital is usually only for the ultra-wealthy, but Fundrise's Innovation Fund gives everyday investors access to some of the top private pre-IPO companies on Earth with an access point starting at $10. They have an impressive track record, already investing over $110 million into some of the largest, most in-demand AI and data infrastructure companies. So if you want access to some of the best late-stage companies before they IPO, check out the Fundrise Innovation Fund with my link below today. Alright, now that we've covered how huge Palantir could get over the course of the AI revolution, let's dive into their quarterly earnings results. Palantir reported record revenues of $828 million for the quarter, which is up by 14% quarter over quarter and 36% year over year. That's solid overall growth, but things get really interesting when we break the revenue down by segment. Palantir's US commercial revenue came in at $214 million for the quarter, which is up by 20% quarter over quarter and a massive 64% year over year, thanks to two key numbers that all Palantir shareholders should care about. First, their US commercial customer count grew to 382, which is up 19% quarter over quarter and a whopping 73% year over year. And second, their net dollar retention rate was 120% for the quarter, which is the highest it's been in 2.5 years. I watched these two metrics like a hawk to track Palantir's overall revenue growth because of how they work together. 73% more customers means much more than just revenue. It also means new use cases for Palantir software platforms, which means that they can build more out-of-the-box solutions to convert even more customers in the future. For example, Palantir Foundry comes with tons of ready-to-go functions and tools for many different markets like logistics and supply chain management, healthcare and life sciences, and even energy and automotive. Building out more AI solutions for these markets and new markets altogether only accelerates Palantir's future growth. On the other hand, Palantir's 120% net dollar retention rate means that Palantir's existing customers are spending 20% more with them this year on average. So 73% more customers and 20% more revenue per existing customer is why Palantir's revenue growth has been accelerating for the last 5 quarters, growing by 20%, 21%, 27%, 30%, and now 36% year over year. And it's not just commercial customers. Palantir's US government revenue grew by 45%, and their overall government revenue grew by 40%, showing shareholders that Palantir doesn't need to sacrifice one side of their business to grow the other. But Palantir didn't just crush it in terms of commercial and government revenue growth. They also crushed it in terms of operating margins, reporting adjusted operating margins of 45%. One thing I want to call out here is that Palantir's GAAP operating margins actually went down significantly due to $131 million in one-time SAR-related expenses. SAR stands for Stock Appreciation Rights, which are a type of compensation that employees get when a company's stock price increases. They're kind of like stock options, except employees don't need to pay to exercise them. So this is a case of Palantir shareholders suffering from success. Personally, I'm not too worried about these kinds of expenses because it's clear that Palantir's leadership knows how to position a high-growth company for long-term success. And at this point, the share price has grown much faster than any dilution or expense has brought it down. Still, I want to call out that I'm using Palantir's adjusted operating margins when talking about their Rule of 40 score, which just hit an all-time high of 81. Fun fact, the Rule of 40 was actually mentioned 9 separate times by 3 separate executives on Palantir's latest earnings call, and they even joked about renaming it the Rule of 81. First, let me explain the problem that the Rule of 40 solves, and then I'll show you why Palantir uses it as their North Star for growth. The Rule of 40 exists because the price-to-earnings ratio is not a one-size-fits-all metric, and many self-proclaimed value investors miss many great investments just because their PE ratios are too high. For example, check out nvidia's PE ratio over the last 2 years. Investors bought tons of NVIDIA stock in 2023 after they began reporting serious data center revenue growth. As a result, their price-to-earnings ratio skyrocketed from 50 to 250 in a matter of months. And I got a ton of negative comments from so-called value investors for buying the stock at all-time highs and at insane PE ratios. But look what happened next. In just 18 months, the stock price tripled, but the PE ratio collapsed because NVIDIA's earnings grew much faster than their market cap. I'm not saying that the PE ratio is a bad metric, but I am saying that most investors use it as a way to justify not taking the time to understand the science behind the stocks, which is just my way of saying how the technology company behind the ticker symbol actually makes its money. So the rule of 40 exists because the price to earnings ratio can be a very misleading metric for companies with high earnings growth, companies like nvidia and companies like Palantir. The rule of 40 says that even if a company has low earnings today, it might still be a good investment if its revenue growth and its profit margins add up to 40 or more. Palantir's rule of 40 score is 81, since their revenue grew by 36, plus their adjusted operating income of 45. The rule of 40 was actually created to compare different companies, since it takes into account the top and bottom lines. So, let's do that next. Here's how different publicly traded software companies score on the rule of 40. The x-axis on this plot is revenue growth, and the y-axis is the company's margins, which means a company's position on this plot is their rule of 40 score. Companies above this diagonal line have a score of 40 or better, and the size of each bubble is their revenue multiple, which is kind of like their PE ratio, but for companies that might not have positive earnings. Anyway, Splunk, which was acquired by Cisco for $28 billion, has a score of 53. Adobe, with its huge portfolio of media editing applications and e-commerce tools, has a score of 51. ServiceNow and Shopify each have a score of 40. So, Palantir's score of 81 is incredible compared to other publicly traded software companies. Even if we use their GAAP operating margins, which was just 1% thanks to those one-time SAR-based expenses, Palantir would have a score of 37, putting them right under Salesforce on this list. It's also worth pointing out that as a company's score goes up, each point is harder to achieve than the last, since they would have to sustain very high revenue growth rates or very high operating margins as their market matures and competition increases over time. That's why most companies have high revenue growth or high margins, but usually not both. So Palantir's score of 81 coming from 36% revenue growth and 45% operating margins means they're absolutely crushing it, just like last quarter and the quarter before that and the quarter before that. Alright, so Palantir's customer count is growing fast. US commercial customers grew by 73% year over year. Overall commercial customers grew by 52%, and Palantir's overall customer count, including their government customers, still grew by a whopping 43% in 1 year. Likewise, their US commercial revenue grew by 64%, while their US government revenue grew by 45%, showing that they can grow their Gotham and Foundry customer base at the same time. Net dollar retention is up, adjusted operating margins are up, and their rule of 40 score is at an all-time high. This was easily one of Palantir's best earnings calls ever, but the stock price spiked by over 40%, and it's now over $110 per share, which means there's really only one question left to ask. Is it too late to buy Palantir stock, or are their best days still to come? And if you feel I've earned it, consider hitting the like button and subscribing to the channel. That really helps me out, and it lets me know to make more content like this. Thanks, and with that out of the way, let's talk about where Palantir stock goes from here. One more thing I want to point out about Morgan Stanley's case study is just how volatile all three groups of these companies are. Semiconductors, infrastructure, and software companies all had huge peaks and sharp drawdowns, and software stocks took an especially long time to catch up to the other two groups in terms of returns. I think the AI revolution is going to play out the same way, which means Palantir should have a lot of big ups and downs on its way to dominating the AI software landscape. Seriously, if this stock isn't for value investors, then it's definitely not for the faint of heart. So be careful and know your own risk tolerance. For me personally, here's where Palantir is on my list of stocks to get rich without getting lucky. I still think that nvidia is the king when it comes to AI, and I don't see that changing anytime soon. Thanks to their Blackwell architecture, their CUDA ecosystem, and all the AI software solutions that they've built on top of it. NVIDIA reports earnings in a couple weeks, and I'll definitely cover them and make a video like this one, so stay tuned for that. Google is a close second because they have a huge portfolio of products, services, and software already benefiting from AI today, including their TPU chips in Google Cloud, their Android and Workspace ecosystems, Google Chrome and Gemini, and YouTube. The list goes on and on. So they're positioned to benefit from all three phases of the AI revolution. But there's no doubt that Palantir is becoming a tech giant in its own right, and they're firing on all cylinders across a huge total addressable market, from national security and heavy industries to supply chain management and finance. They were my best performing stock in 2024, going up by 395% over the course of the year, and they're already up by another 50% in 2025. So my plan is to keep dollar cost averaging in, which means I'm buying fewer shares as the price keeps getting higher. The next time there's a big dip, and there will be a next big dip, I'll average in even heavier. But for now, I'm going to move Palantir stock up one spot on my list, just above Broadcom. That's actually a really big move, considering how confident I am in Broadcom's ecosystem of ASICs, networking solutions, and big software acquisitions like VMware and Symantec. But this is why it's so important to understand the science behind the stocks. And if you want to see what else I'm investing in, make sure to check out this video next. Thanks for watching to the end, even though I gave you everything up front. And until next time, this is ticker symbol U. My name is Alex, reminding you that the best investment you can make is in you.